Hello there. The week ends with the G20 meeting getting underway in Shanghai, where China is keen to assure world finance leaders that its house is in order. Now, alongside this, Mark Carney said that he was concerned by some central banks using negative rates to try and boost growth. And Brexit, of course, will no doubt be discussed by the G20 too. Well, whatever is said over the weekend, it's likely to set the tone of the week. But let's take a closer look at the economic data due out there. We'll kick off with Monday. So we've got Japan industrial production, the retail trade coming up, Germany retail sales as well, UK mortgage approvals, Eurozone CPI and US Chicago PMI, the pending home sales. On Tuesday, it is all about the RBA interest rate decision, which we're going to analyse in just a minute or two. China, Japan manufacturing PMI as well, France, Germany, EU, UK, US manufacturing PMI. So it's a PMI week. EU, Germany unemployment rate as well, and Canada GDP in the mix. On Wednesday midweek, we'll have Australia GDP, UK construction PMI, US ADP employment report, and the EIA crude oil inventories as well. Crude very much at the forefront of investors' minds still with the oil glut in existence. Australia trade balance, and again PMI data, plenty of it. China, France, Germany, EU, UK, US, and the EU retail sales. Towards the end of the week, it's going to be the US in focus, but we've also got Australia retail sales, France trade balance. As I say, the US non-farm payrolls, extremely important because we've got the Federal Reserve meeting coming up in March. What are they going to do? We don't know. US trade balance as well, and Canada trade balance as well. So busy week. Okay, got Chris Beauchamp just here to talk about all of that. Lots coming up. Let's start talking about Australia then. The Reserve Bank of Australia, what do you expect them to do? They're going to ease policy, and what's going to happen to the Aussie dollar?
It could be an interesting one. We've got the RBA seeing some signs of weakness, I think, within the Australian economy. And certainly there's expectation that we're shifting towards a looser monetary policy posture, which would match what we've had from the likes of the Bank of Japan, the ECB, and also more or less the Bank of England. So if they do cut rates, the impact on the Aussie is likely to be further falls. We've seen the price move back today off the highs of the week, and you can see that red line there in the top round. That's the 200-day moving average, and the failure to move above there is a relatively negative development. What we are looking at is also this black line, the descending trend line here that's been in place now for a number of months. And if we get back below there, I think the risk is that we do see an unwinding of the February bounce in the Aussie dollar, and we go back towards that 70 cents level that was so important in the first half of the month. And that's been the area around which the Aussie dollar has battled it out with the US dollar over the past year or more, and that could be very interesting to see if we can move back to that level, and then whether we'll continue to move lower.
PMIs, lots of them. UK, what's going to happen there?
Very much, of course, focus this week has been on the UK and its potential exit from the European Union. So that's really knocked sterling, but that detracts from the important focus on what the UK economy is actually doing. We get those PMI figures this week from construction, manufacturing and services sector, so all three really, and services the most important of those. So if we see improvement, we could actually see a bit of upward momentum in the pound, certainly against the US dollar, which slumped through 142 and also through 140 this week, hitting levels we've not seen in a number of years, in fact, since March 2009. But at the moment, we've managed to stop going lower on the pound against the US dollar. So it could be interesting if we get a strong set of numbers from those PMI figures to actually push us back in the direction of that 142 level and get what we call a short squeeze. All those people rushing in to short the pound last week on Brexit concerns, and a few of those late to the party. If you get a move up above 140 at the opening part of next week, that could accelerate the move to the upside and go back towards that 142 level, at least in the short term.
And then on Friday, it's the crucial non-farm payrolls, and these are extremely unpopular this time, aren't they?
Yeah, this could be an interesting one. Of course, non-farms always command attention, but we are at that stage where the actual number is not quite so important anymore because the US economy is assured. What you have got is continued drop in the unemployment rate and improvement in average hourly earnings, and that's really what Janet Yellen is looking for at the moment. She can say, actually, yes, there are concerns about the US economy, but that slack we talked about, where there's still room in the US economy for more employment growth, is starting to reduce. So that means as the labour market gets tighter, wages start to rise because there's less available workforce, if you like, to choose from. So because there are fewer workers, they have to respond with higher wages, and that helps promote inflation as well. So you get this virtuous cycle in US economic data. In terms of the market impact, I think we're keeping an eye still on the dollar against the Japanese yen, which is a key barometer of risk appetite at the moment. And this week has been interesting because for the second time in a month, we've tested that crucial 111 level, that blue line there on the chart. During the first part of the month, we sold off heavily in this currency pair. You can see that downward move there, and we got down to 111, and then it bounced for a couple of days. It moved lower again in the second half of the month, but as we're running towards the very end of February, of course, that 29th of Feb, once in every 4 years, we've actually started to move high, and you can see that moving in the direction of that 114 level. If you get back above there, so if you go back, I think if we close above 114.60 or 115 itself, that might suggest we get a bit more positive momentum as the dollar strengthens on expectations. Actually, the Fed might move policy this year, because that's still the debate. Do they move on from their current one increase in interest rates, or do they stand pat now? Previously, market pricing has been that they wouldn't move at all in 2016. That was the big story of the first month or two of this year. That actually the chances of a rate increase at all in the year had almost evaporated.
Because it was such a dire month.
Exactly, but that's not to be unwound again now. The market's moved back and thinking, well, maybe we might get one later in the year. March is probably a very distant prospect, but there are some still suggesting they might. But certainly, we might get one or two this year. So that non-farm payrolls number, not so much the headline number, but we'll look at what the wages are and what the unemployment rate itself is doing.
So we might see those interest rates normalise at some point. All right, then, that was the economic run through. Let's see what's coming up in the corporate world. So on Monday there, we've got DX Group just there. It's a British mail courier company. We've got Brunsell as well. It's the outsourcer distributing coffee cups, carrier bags, syringes, mops, whatever you like. Hiscock as well, the insurance provider. Keller, engineering company, and the Mirror as well. I used to work there many years ago. Tuesday, we have got Ashti just there. We've got Arms Holdings as well, and Glencore very much in focus, the commodity giant. MoneySupermarket.com, and we've got Taylor as well in the mix, and lots of edibles too, Greggs and Just Eat. Okay, on Wednesday there, you've got the pharmaceutical giant just there, the Clinigen. You've got Stagecoach, ITV, and Abercrombie and Fitch. On Thursday, we've got Travis Perkins there, BBA Aviation, Admiral Group, the insurance company, and Adidas as well, the sports giant, and DeLonghi as well, the coffee machine maker. On Friday, finishing off the week, we got WPP. We're going to talk about that one just now, Lookers, and the SNB too. So it's a very mixed plethora going on, but we've got to talk about the financials because they are in focus at the moment. Very mixed this week. Actually, Barclays is the last one of the big five to report, and it's not expected to be particularly promising, is it?
No, Barclays still really suffering the after effects of the hangover, if you like, the global financial crisis, even at this late stage. We've had excellent results this week, or at least an excellent reaction to the Lloyds results, RBS not doing so well. And Barclays, if you like, is the last sort of UK focus. The question is really where the growth comes from. They've certainly seen a much more difficult trading environment, and the share price reaction has been understandably negative. You've seen a steady decline in the share price now, almost a one-way move in October and then onwards from there. In February, we've managed to hold above that £1.60 level for a number of days. So that's our first area to watch in the coming week. And then if we can push on from there, if the results are ahead of expectations, then that certainly provides a bit of positive momentum. So we're looking for maybe a bounce towards that 50-day moving average in the first instance at about 187p.
All right. Well, something entirely different then. We've got WPP. It's the world's largest marketing services group. Anything exciting to look forward to?
Well, WPP has been, essentially it's a play on global growth, and we've had weakness in a couple of markets over the last few months, which has made people a bit concerned about the share price, and it has been a very choppy few months for WPP, at least in terms of the share price. Overall, the businesses still remain fairly solid, and the valuation, it was a bit toppy about a year or so ago, but you've seen it come down to about 16 times earnings at the moment, which isn't too demanding. It does allow for some room for disappointment. In terms of the share price, though, you've seen it move back towards this high from the very beginning of the month at about £15.20 a share. So that's a good thing. It's a strong bounce off the lows of February. But you can see, actually, we've also got this descending trend line from those highs right at the end of last year. So if we can't get through £15 a share and hold above it, if we can't get through that sort of £15.20 area, then the risk is that we do get a move lower for the time being. And certainly the shares do look a tad overstretched on the upside.
Okay, so we've done financials, we've done the marketing. What about the residential house building company Taylor Wimpey? It's got exposure here in the UK and Spain as well, hasn't it? What are we expecting?
UK house builder has been interesting. They've been a very strong performer over the last few years, and now that growth has started to slow, at least again for the share price. They're sitting on very strong land banks, and if you look at the fundamental outlook for the sector, you've got reasons to be optimistic because UK consumers seeing their incomes rise, which is good obviously for people looking to buy houses. You've also got an expectation that the Bank of England won't raise interest rates for a number of months, if not even years, and so mortgage rates are very low and makes it easier for people to get hold of mortgages, so you can expect more sales coming through for the sector. They are a bit overvalued, I think 2.5 times book value, really, which tends to be a fairly high level for a company. Anything over 2 is considered fairly expensive. So the risk is that these high growth stocks, which house builders tend to be, could see a more broad-based sell-off if the market starts to turn lower, as it has been doing. Nonetheless, in terms of the share price, holding above the lows of the month at £1.70, we'd like to get it back above that 200-day moving average, that red line there at £1.90 a share. And that would clear the way nicely just to get back above £2, which is where we were in August, September, and again in December.
All right, well, that is it. Okay, so we've done our economics and our corporates, and indeed that is the week ahead. So have a great weekend and a great week next week. And of course, we're entering March, aren't we? I can't believe it. Goodbye.